Peter Henry.
And China's mysterious tourism numbers. We speak to the author of a report about how the changes are impacting the global economy, especially Europe.
We begin with our market minutes after almost 2 months of public silence about the timing, the size of the next rate move. Janet Yellen spoke today, and what happened? U.S. stocks closed mixed after Yellen's comments. The S&P 500 and Dow declining for a third straight day. 7 out of 10 major S&P 500 groups declined. Healthcare was the best performer. The Nasdaq finished just in the positive, barely though, up 0.1%.
There you go. That Nasdaq has remained somewhat buoyant throughout the past couple of weeks when things have gotten pretty rocky. Looking a little bit deeper into the stock market, I want to look at a couple of those sectors that you mentioned. In particular, when you look at the one-day moves today, as you pointed out, utilities not doing so well. Obviously, that has been part of the market that's been hurting quite a bit.
The death of the safety trade. That reminds me of the death of the safety trade.
The death of the safety trade and the birth of this conversation that will keep happening. Financials group held up a little bit, perhaps due to the idea that we might be getting more hawkish. But if you look at the 5-day change, this is what's a little bit more important. Where you're looking at some of those same groups, but a little bit bigger moves. Not huge moves on the week, but you are looking at that same kind of reversal of the trend in which those financials are staying in the green. Energy also getting hit. Commodity not doing too hot. Utilities down 2.3% on the week. Quite a bit of a loss there, in tech staying above. But one thing in particular today that was interesting real quick was the VIX. If you look at volatility, this is kind of one of those days where the VIX actually might have explained the market. If you're trying to figure out why stocks were jumping around on all the Fed speakers, well, the VIX shot right down with Yellen as he removed some uncertainty about what she was going to say. And then guess what? It went right back up to positive and then eventually flat after Fisher then came and muddled that message a little bit.
I want to also point out that St. Jude's is seeing a little bit of action today. I've got a 3-day chart here on my terminal, and you can see that I put a line at the close of day 2. Day 2 was when Carson Block came on Bloomberg Television exclusively and told the world of his short trade on St. Jude's. And then we spoke with MedSec, the securities firm, as in cybersecurity firm, that he teamed up with in order to find the vulnerabilities that they claim, that they allege are present in St. Jude's medical, certain St. Jude's medical gear. You can see, though, on day 3 of this 3-day chart that the shares have now completely recovered their 3rd-day losses as St. Jude's comes out and essentially denies some of the claims that Carson Block and MedSec made.
In the meantime, let's check what happened in the bond market. The 2-year yield was particularly noticeable here because the prospect of a rate hike this year had sent bonds tumbling. That was following Yellen's comments. The 2-year note, as you know, most sensitive to Fed expectations. Prices dropped, which means yields go up, and that's what happened there, to 84 basis points if you round it up. That is the highest level since June. But, of course, the Fed also said future rate increases would be gradual. So longer-dated debt did not falter as much, and you see that at the longer end of the yield curve. Yes, yields moved up on the 10 and the 30, but the overall result is a flatter yield curve.
I want to take a look at some of the currencies that have moved today. Initially, there was a head fake this morning after Janet Yellen's speech began. You saw some dollar weakness. Take a look at the pound, take a look at the euro, take a look at the yen, or take a look at this screen here. I've got the dollar rising. This is a 1-day trade. You can see the initial drop with the red arrow here, and then eventually the dollar climbing to real strength throughout the afternoon. If you do look at any of those currencies, pretty much any currency, you're going to see a stronger dollar because I think only the yuan and one other small currency among the expanded majors. In fact, I'll pull it up. I'll pull it up right here. WCRS, and then we can see exactly what happened with currencies. Go ahead and take a look at my I'll put expanded majors in here rather than just the majors, and you can see that almost nobody, the yuan and the Indonesian rupee. I knew it was
Rupiah.
Rupiah. Thank you. Thank you,
Indian
Scarlett.
rupee, Indonesian.
But I'm saying yuan correctly.
You are saying yuan correctly.
Thank you.
Nice work. All right, let's take a look at commodities as well. Oil climbed to as high as $48.46, but did give back most of its gains. Copper and gold, little change there. Zinc, I wanted to point this out because it rallied to a 15-month high in London. It's been the best performing commodity this year, up 42% so far this year. You have signs of a shortage with demand holding up. Zinc, by the way, is used to rust-proof steel, which I did not realize until today.
Oh, yeah, that's an important ally.
All right, those are today's market minutes. Now let's take a deep dive into the Bloomberg, and you can find all the following charts using the function at the bottom of the screen. And with all the talk from Jackson Hole on where interest rates could be headed, may be headed, I wanted to take a look at WIRP, the function that allows us to check how traders are anticipating future rate increases. Right now, as you can see, the odds for a September rate increase are now at 42%. And I'm going to highlight this so you can see it better right there. 42% for September, 50% for November, and 60% for December. Now, what's interesting, of course, is if you go back to, say, yesterday before Janet Yellen spoke, and it was at 32% yesterday, 43% for November, and 54% for December. And let's just take it back, why not, to another 2 weeks ago. And you can see the odds were much, much lower there. In December, 42% odds.
I think that basically tells us the takeaway from all that Fed speak today was a little bit of a change, but nothing huge. There was no, vast repricing of in the Fed funds futures market.
No, you know what? I was really nonplussed when I saw the headlines start to pour out of Janet Yellen.
Maximum optionality, Matt.
Yeah, so they're keeping maximum optionality. That's not really exciting for us or for the market. And the problem is that $6 trillion worth of bond managers are really frustrated by the direction or lack thereof that they're getting from the Fed. And the question of the Fed's credibility is also in play. You know,
Mike McDonough just messaged me right now, Mike McDonough of Bloomberg Intelligence, saying that you really need the odds for a specific meeting to go up to 70% for there to be a very good chance that the Fed will follow through, even though we've heard from plenty of people as well. This Fed, too.
I mean, even then, we've seen in the past 70 doesn't even do it.
Exactly. Well, they want to get to 50% to keep that maximum optionality.
I have a chart that, Oliver, I'm sure you've seen a number of times, but it shows corporate profits, and we're in the longest slump right now that we've had since the end of the recession in mid-2009. Here you can see, broken down by quarters, a histogram that just shows you how bad it's been. The last time we saw a slump like this, I guess, ended in the second quarter of 2009. This weighs heavily on GDP. And before you see GDP really start to turn around, you've got to see this pick up. So if we see this kind of thing to continue, you're not going to see the strong GDP that people will tell you is necessary for normalization of interest rates. A 3.5% level of growth is what we heard today that from economists and from who was it that came on and said 3.5% is what you need to see. The ETFs, the Shark Tank.
O'Leary.
Kevin O'Leary was telling us that he's not an economist, obviously, but he's someone who's very active in the market. So he's watching it very, very closely and has a lot of money at stake.
So that chart, there's another red bar there that used to be green, and that's expected earnings for next quarter. Barely in the red now, but still some more negativity on the earnings front. Real quickly, I want to look at a potential explanation, if you will, for maybe why markets kind of ended up flat to selling off a bit today. I think part of it might be because there was just a positioning situation where maybe there wasn't a lot of direction in which they could go. The bottom panel here I actually want to call attention to first, which looks at the moves on a yearly basis in terms of what happens after a Jackson Hole speech. Generally, when the Fed chair comes out and talks, stocks go up the next week. And the top panel is looking at short interest coming down. It's looking at a sentiment gauge by BNP called the Love Panic Index, which assesses how much investors like U.S. equities. And basically what you're looking at is a pretty big move up, where if you look basically the past couple weeks, that panic gauge has jumped up right here, the most in 4 years. Short interest has come down right here. So the fact that maybe this is sort of a selling type event, regardless of what happened, just one possible explanation.
All right, Bloomberg Gadfly stocks columnist Mike Regan joins us now with, what are you going to wrap up the week here for us a little bit? Take a look at what happened after Janet Yellen didn't disrupt the markets.
Yeah, obviously the week boils down to one speech that everyone was waiting on the edge of their seats for. And, Charlotte was talking about the world interest rate probability function. It's fascinating to me how all of us, and I think a lot of traders everywhere, are glued to that thing, refreshing it every day. What amazes me is how swiftly that thing can move. 43% chance of an increase in September as of today. After Brexit, it was literally zero. Before Brexit, it was above 50%. So it's a very important signal that everyone's looking at, but it's one of those signals that's based on a relatively small market, Fed funds futures trading. Not a hugely liquid market on a relative basis compared to the stock market, which is way bigger, but yet everyone in the stock market is taking its cues off of that and the bond market. So the takeaway for me is that it is an important snapshot that we can look at any time, but it's a signal that's written in pencil, very faint pencil, if anything, and not pen. And I think that's the important takeaway from today is, yeah, the odds look a little bit higher. December looks like a much greater possibility, but another data point, another conflicting speech from a Fed member could send it the other way.
One thing that did move today, of course, utilities group. One chart that I know you're looking at, if we can jump into my terminal real quick, is the utilities dividend versus the 10-year, and this thing is just way above where treasuries are offering. What does this tell you about the sort of market moves we see on days like today?
I like what you were saying, the death of the safety trade. I might have to steal that from you there.
It's the birth of the phrase.
There you go. Or the safety trade's gotten much more dangerous. And it's interesting because, yes, traditionally you look at these groups as the safety trade, defensive industries, consumer staples, telephone, utilities. It used to be healthcare, but that's kind of been dismissed because of the biotech and the questions about pricing with the election. But it's really been not so much a safety trade as just this desperate hunt for yield trade. And it's not like utility yields are higher than they've been traditionally. They're actually much lower than their average over time. It's just that bond yields are so low in the U.S.
Well, check out I've got the 1 month. GRR, group rank returns here on the S&P, right at the bottom over the past 30 days. Utilities, telecoms, healthcare, consumer staples.
Dividend payers.
And these are the, traditional safety groups. So
right, and that rotation into your more cyclical industries, tech, financials, energy. I mean, of course, energy's got a mind of its own, but financials, especially the S&P Financial Index today, reaching its highest level of the year, and it's a big, broad group of companies, but very heavily weighted to the Berkshire Hathaways, J.P. Morgans, the groups that really stand to benefit from higher rates. So the stock market seemed to be a little bit more confident that a rate hike's coming.
Yeah, a little bit of volatility here. Thanks so much for breaking it down with us. It's Mike Regan, Bloomberg Gadfly. You can catch all of the fast commentary from Gadfly columnists like Mike at NIGADF Go on the Bloomberg terminal.
All right, coming up, more live interviews from Jackson Hole, Wyoming. Notable economist and dean of the NYU Stern School of Business, Peter Henry, will be sitting down with Mike McKee. This is Bloomberg.
What'd you miss? The stock market optimism with Janet Yellen's bullish comments on the U.S. economy fizzled after the Fed Vice Chairman Stanley Fischer said an interest rate increase is possible in September. Let's head back to Jackson Hole, where Bloomberg's Mike McKee is standing by with Peter Henry, the dean of the NYU Stern School of Business. Mike?
Well, and Mark, you know, Dean Henry had the catbird seat for Janet Yellen's remarks and for most of the discussion this morning because he was the moderator of the morning session here. How was it received in the room? Wall Street has one view, but these are academics and Fed policymakers who are looking at this from a different perspective.
Yeah, I think everyone in that room is really taking the long-term view. People who are waiting for revelations to come from the podium, I think we're a bit disappointed. But I think there's a view that says we have to think about putting in place resilient monetary policy frameworks for the next crisis, not thinking about how do we change monetary policy over the next couple of weeks or months.
Well, is there a general consensus that policy, as we know it, has run its course?
I think there's a strong view that monetary policy has done most of what it can on its own to really generate a recovery. Monetary policy has been very competent, but I think that there was a strong sense that we are all waiting for the fiscal side of the house, if you will, and for lawmakers to really step up and do what must be done. Monetary policy has created the conditions that can allow growth, but we haven't seen, for instance, we've seen really contractionary fiscal policy during the period of sequestration that was working against monetary policy. And we're not seeing policies that can really drive improvements in productivity. So much more needs to happen other than monetary policy in order to see the kind of robust growth we all would like to happen.
But if that doesn't happen, and policymakers have shown no signs of courage lately, does monetary policy continue to step into the breach, and then does that become harmful?
I think there's a real danger of overreach. I think that if you listen to Chair Yellen's remarks, you'll see, I think, very, very strong evidence of somebody who's aware of the dangers of overreach. Monetary policymakers, central bankers need to be humble. Right? They were heroes for a while, and the time of the crisis really called for great heroics. Now that we're moving to a period of normalcy, even though that period is one of much slower growth than we'd all like to see, we have to recognize that monetary policy really has, as you said, run its course in terms of what it can do to really propel us forward.
Well, if it's not propelling us forward, it's reacting to the next recession. Is there any confidence that, since policy has run its course, is there any feeling that perhaps the central banks will come into the next crisis with less ammunition?
There's a sense, if you listen to the chair's speech this morning, given what we know today, there are reasons to believe that the current arsenal that the Fed has is sufficient to deal with what may come. So, for instance, if you look at interest rates historically during the times when the economy has gone into recessions, it turns out that the stance of monetary policy has unexpectedly been relatively tight at the beginning of recessions, meaning that there's been a need for much bigger interest rate moves in order to provide the slack that the economy needed to get back on track compared to where we are now. So even though interest rates are nominal historical lows, there may be more slack in the system presently than is fully realized relative to past recessions.
It was a morning of prominent economists putting theories on the table and having them discussed within the room. What drew the most interest?
I think what drew the most interest was this notion that the natural rate of interest is at an all-time historical low. By the natural rate of interest, we mean if we think about what is the rate of return to capital, and that ultimately really drives bond yields in an economy. And the fact that we're at all-time historical lows means that, frankly, the monetary policy has reached a point where it can no longer do much to really drive real investment over the long term. So that suggests, again, that we need things like increases in productivity, policies that will reduce the inefficiencies in the economy, great openness to trade. One of the other things that's pushing down the natural rate of interest is the lower labor force growth that we've seen in the United States and certainly in advanced countries more generally, which points to things like immigration. So lots of hard, what we call structural reforms that need to happen to drive productivity, drive up the natural rate of interest or the underlying rate of return to real investment in the economy in order to propel growth. And the question is, which lawmakers are ready to actually embrace this reality and make the changes that we need to drive the economy forward?
There does seem to be general agreement that one of the biggest problems, and least understood, is this decline in productivity that we have seen. Were anybody come up with a theory for what is causing it and what should be done?
No definitive theory, but just to give you a sense of just how serious the decline is, from 1946 through roughly 2005, average productivity growth in the United States economy was 2.5% per year. Since 2006, it's been about 1.25% per year, so half of that rate. And that's very significant if you also combine it with the fact that labor force growth is also slower than it's been. Historically, labor force growth is about 1% per year. It's declining to something closer to about 0.5% per year. So those two factors together automatically lock you in to long-term potential growth, which is less than 2%, which is far below what we've seen in the past, something closer to 2.75, 3%. So that's a real challenge.
Let me quickly ask you, when you're in a conference like this all day, you're basically talking about worst-case scenarios and what do we do about them. As you come out of this, are you optimistic? Are you pessimistic? How do you feel about the future course of the U.S. economy?
I feel positive to neutral. I think that the Fed has done an extraordinary job over the last almost decade now of grappling with a very severe crisis, putting in place new tools to help us deal with that crisis. There's stability in the economy. We're growing again, but it's hard to be overly optimistic when we're growing at 2%, and even with unemployment down to 5%, there's still a real sense of having an economy that's not producing the kind of income gains that are either large enough or widely distributed enough to really lift the average working American family into a place that makes them feel confident. And because of that, there's this reinforcing effect that people are expecting less of the future in terms of their income, in terms of their ability to put their kids through school. And so that in of itself is having a dampening effect on the economy today. Same thing with businesses. Businesses, because of, we talked about this lower rate of interest, lower expected rate of return, are not investing as much because they're expecting less of the future. And so lower expectations about the future translate into lower expectations today.
All right, Dean Peter Henry, thank you very much for the New York Stern School of Business. Going to send it back to you in New York, and hopefully you can be optimistic.
Thanks so much, Mike. That's Bloomberg's Mike McKee and NYU Stern School of Business Dean Peter Henry in Jackson Hole.
Coming up, the FTSE and the Euro Stoxx 50 tend to move in lockstep, but their correlation has declined. We've got the chart that you can't miss. This is Bloomberg. Fu, what you missed, diverging paths between European and UK stocks after the Brexit vote. So this chart here shows how stocks in the UK and Europe tend to move in lockstep, and it doesn't really matter actually which one is which until the Brexit vote, which is the vertical red line. Since then, the FTSE has really taken off, while the Euro Stoxx 50 has kind of lagged behind. What's been driving that outperformance? The pound's weakness, which has boosted the FTSE by about 7.5%. European stocks, meantime, have fallen by about 2%. This bottom panel here shows the 30-day correlation between the two indexes. When the line goes down, the correlation is breaking down. And right now, it's at the lowest level correlation, that is, going back more than a year. So it's an interesting divergence to keep track of, especially as everyone's looking for data to back up the fact that the Brexit vote was supposed to be terrible for all the regional economies.
Well, this is because, keep in mind, you're looking at the FTSE 100, and
yes,
those are companies that export a lot. So when you see a big drop in the pound, that's beneficial to those companies. That'll look very different if you track it against the FTSE 250, which has much more domestically oriented companies. Nonetheless, economic surprises have been very positive in the UK. Take a look at this function I've got on the Bloomberg, ECSU. Right now, I've got it open for the US, and you can see that we've had a little bit of green here at the end. That means positive surprises rather than disappointments. The drop-down menu allows you to look at the Euro area and the United Kingdom as well. I'll go ahead and blow up this chart. It's a multi-year look, so it goes back to 2009. But if I zoom in on just 2015 and 2016, you can see that here in the second half of the year after the Brexit vote, we still have had a string of really positive economic surprises. It's a great function. I recommend you use it. And then you can also ask yourself what's going on after the UK voted for Brexit, since we should get, you'd think, disappointments, but maybe people lowered expectations.
All right, so that is a very sort of domestic-looking stock, domestic-looking function for the UK. And then we talked about the multinational stocks doing well. I'm going to kind of hone in between and look at some more domestic numbers at the UK that suggest maybe it's not just larger companies taking advantage of the weaker pound. This is actually retail sales in the UK. Your white line versus some of its global peers: Japan in purple, Canada in orange, Germany in teal, whatever you want to call it. But look at this. This is a pretty solid number here. Not only was it an expectation beat, but it's really the highest since 2014. This is year-over-year percent change in retail sales. So perhaps out of all the jawboning and talking about what Brexit would do, it hasn't been terrible thus far.
Well, Matt did buy a lot of ties when he was in London. So.
There you go.
Every day, every day.
See? All right. Coming up on What'd You Miss, a closer look at China's mysterious tourism numbers and why they don't totally add up. This is Bloomberg.
I'm Mark Crumpton. Let's get to Bloomberg's First Word News. The impeachment trial of Brazil's president turned into a shouting match and was temporarily suspended for a second time today. The head of the Senate declared, quote, "Stupidity is endless," and sharply criticized a colleague who questioned the body's moral authority. Suspended President Dilma Rousseff speaks on Monday. She's accused of breaking fiscal rules in her management of the federal budget. She denies any wrongdoing and says her enemies are trying to stage a coup. Meanwhile, former Brazilian President Lula is facing corruption and money laundering charges. The former labor leader has repeatedly denied wrongdoing and says he's the victim of political persecution. France's top court has overturned a town burkini ban. The move comes after some Muslim women were ordered to remove body-concealing garments on French Riviera beaches. The ruling by the Council of State specifically concerns a ban in the Riviera town of Villeneuve-Loubet, but the binding decision is expected to set a legal precedent for all the 30 or so French resort municipalities that have issued similar decrees. And a SpaceX Dragon capsule's back on Earth with scientific gifts from the International Space Station. The spacecraft parachuted into the Pacific just off Mexico's Baja California coast. It's loaded with 3,000 pounds of research and equipment, including a dozen mice that traveled on the Dragon as part of a genetic study. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett, back to you.
All right, thank you so much, Mark. Let's get a recap of today's market action. Janet Yellen finally spoke after almost 2 months of silence, public silence on where interest rates are headed. And what did we learn? Well, more optimism on the economy overall. Oliver's shrugging his shoulders, while also some speculation that interest rates could rise as early as next month, which is what we kind of knew before she spoke as well. So stocks in the end didn't really do very much.
I thought for sure that her original comments kind of put an end to the conversation, debate about what was going to happen this year, that one hike was very much still on the table, and that's kind of what people expected. Markets did well. But then Stanley Fischer came out and basically commented on Yellen's comments and, got things really murky.
Also, volume is pretty thin, let's not forget, because a lot of people have already left. It's a Friday in late August. That's what tends to happen.
I think a lot of participants see this Fed as kind of like Elon Musk when it comes to his production promises. He's going to make the car, but it's going to be a lot later than he actually says it is. But probably he's not going to make as many as he said he could. So
fair enough. In terms of the numbers, I get it. However, I feel like, I don't know, there's a lot of questions about whether or not we will actually get to any more hikes. There's a lot of people out there that still
there are some people that say there's never going to be a rate hike ever
I just like the comparison of the Fed to Elon Musk. All right, well, let's switch gears to China here, because I want to take a look at how China's yuan has been declining. We know that this has been a gradual depreciation by the Chinese government, but this is something that George Magnus of UBS pointed out. It's a normalized chart, so everything goes back to 100. And China's yuan has been falling against the basket of currencies since its inception at the start of 2016. The basket is the white line, the CFETS, the China FX trade
There's
system.
a white line?
Yes, it's right there. It's kind of hard to see, but it's in the middle there. That's all you need to know. Down almost 7%. And in terms of who the steepest losses are against, mainly the yen here. That's the yen down here. And also the ruble. Of course, the renminbi, the Chinese yuan, has gained against the British pound quite a bit, 9%. According to Vince Signorella of Bloomberg First Word, the weakness in China's currency obviously helps keep financial conditions on the looser side, and it gives China more leeway with monetary policy. For Japan, obviously this yuan weakness is probably a concern.
But for the people, the retailers on Sloane Street, it's a very good thing. Harrods does good business with Chinese customers.
That is a great point.
Yeah.
There you go.
Thanks, George Magnus, for the chart.
All right, we're going to stick with China because there's some stuff in China that you might have missed. Its tourism boom that it claims doesn't quite add up. The country's deficit in tourism rose from $75 billion in 2013 to more than $200 billion in the last 4 quarters. The Council on Foreign Relations says the numbers don't make sense. Here with us now to walk through that is Brad Setzer. He's a senior fellow at the group who did this study. Brad, great study. We took a minute, trying to figure out all the terminology, but let's just start from the top here. China basically says there's a tourism deficit, meaning that Chinese tourists are spending more abroad than other countries' tourists are spending in China. Is that sort of the top line case that we're looking at here, and what is China saying about that?
That is exactly what China is saying, that there's, no doubt it's in part true. Chinese tourists probably do spend more outside of China than foreign tourists in China spend inside China. The question is the pace of the increase. So in 2013, China reported that Chinese tourists traveling abroad spent about $100 billion outside of China. In the last 4 quarters of data, that has gone up to $300 billion. It's a spectacular rise. To put it in context, that's almost equal to the fall in Chinese spending on commodities over the same period of time.
That's huge outflows for the currency. Does that worry the government? I mean, that sounds to me like they're trying to get their money out of Chinese assets.
That's the most likely explanation, that some of the reported increase in tourist spending outside of China is capital outflows. However, there's an offset, and it's an important offset, because the other implication of this data is that China is actually running a bigger current account surplus, a bigger goods and services surplus than is actually reported, so it has more capacity to sustain financial outflows.
And here we have a chart that kind of illustrates why there's reason to be suspicious of this data. You have Japan and other countries where Chinese tourists are heading to, showing that the numbers that China claims don't quite add up. There's a pretty big discrepancy, isn't there?
There is. So the Chinese numbers, as I indicated, are basically tourism spending over the past 10 quarters is up by a factor of 3. In the U.S. data, it's up by 50%, which is kind of reasonable. There's no doubt there's been a stronger increase in Japan, and that shows up in the data. What the really big discrepancy, though, is Hong Kong. So there's traditionally a lot of Chinese tourists go to Hong Kong. And Hong Kong doesn't provide a breakdown of spending by Chinese tourists.
And there's the Hong Kong line at the way bottom.
Way bottom. But you see that total spending by tourists in Hong Kong has actually fallen, even as the reported spending, or what China thinks its tourists are spending abroad, has soared. Historically, 30 to 40% of Chinese tourism has sort of showed up in the Hong Kong data. Over the past 2 years, that's gone down to about 10%. It just doesn't quite feel right.
Okay, Brad, so I want to get to why this matters and why China's government might potentially be sort of fudging these numbers, the numbers that you're casting doubt on. Because you mentioned this goods surplus. Let's make the connection between the surplus in goods and this tourism deficit. Are they basically saying that perhaps there's more money going out via tourism, and that explains the surplus in the goods, that people are spending their money elsewhere instead of in China? And what would their motivation be for having that discrepancy and pushing those numbers up?
So I'm not convinced it's a conspiratorial thing as opposed to a simple mismeasurement thing. Unambiguously, as Chinese investment has slowed, Chinese demand for the rest of the world's goods has fallen. You see that in all kinds of data. And you see that China's spending on imported commodities has really tanked. That has had reverberations through the rest of the world. If China's tourism data is real, then a lot of the decrease in Chinese spending on goods has been offset by increased Chinese spending by Chinese tourists. So the aggregate impact on global demand shouldn't be that bad. If it's Chinese tourists going abroad and buying financial assets, that doesn't generate demand. That generates, it just adds to kind of the global savings.
And that would be capital outflows then?
That would be capital outflows, exactly. So it adds to the capital outflow at a time when you can see from low global interest rates, weakness in demand, setting aside the possibility of a U.S. rate hike for now. In general, the world doesn't need more capital outflows from China right now.
It also kind of changes the narrative of what's going on in China, because the goods surplus would suggest that they're getting more of the things that they need domestically, right? That their domestic economy is starting to grow, which is what they want, which is what I think everyone wants. So if these tourism numbers, though, are right, maybe they're just getting foreign products and bringing in foreign things through other means.
That's another possible argument for why the deficit is so big. The hard part on that is if you look at like luxury goods sales, other indicators, it doesn't quite seem to match up any better. But in general, yes, there's a story about import substitution, that China is making more of the goods.
Thank you for putting that so succinctly, what I took 2 minutes to say.
And then the way that is not so bad for the world is if Chinese tourists are really spending a lot outside China. If they are not doing that, then the positive impact of China's consumption boom for the rest of the world is a little bit weaker.
Which of these potential explanations do you guys feel is the most possible, probable?
I think some of the increase is real. There has been growth in Chinese tourism in Japan and Thailand and some other destinations. That increase, though, is not big enough to explain the full growth. So I think a meaningful part of it is disguised capital outflows. And I think the more important implication is not that there's money leaving China, which we all know. The more important implication is that China is providing less demand to the rest of the world than we thought.
Very interesting stuff, Brad. Great conversation, great paper, a fairly, I might dare say, sophisticated conversation for a Friday. It's Brad Setzer. He's on the Council of Foreign Relations. Thanks so much.
Thank you.
All right, we have some breaking news. Carl Icahn saying that he today bought 2.3 million shares of Herbalife and that he continues to believe in the nutrition supplement company. He also adds that he never gave Jefferies an order to sell any Herbalife shares. And of course, this comes in response to Bill Ackman. You can say the hedge fund manager who has taken the opposite trade on Herbalife in terms of shorting it and betting against it. Hedge fund manager Bill Ackman had sent the stock of Herbalife down today after saying that Carl Icahn is trying to sell his stake. Again, Carl Icahn has come out and said that is not the case. In fact, he today bought 2.3 million shares of Herbalife. Herbalife had closed down at $1.43 at $60.50 a share.
That's pretty huge news. I'm looking at Herbalife right now in the after hours jumping. This was a big deal. It sent the shares down, and the fact that Icahn is then basically refuting this claim and saying that he's not only not selling but adding, that's pretty big, and the market move here is reflecting that. Ackman can't catch a break here on Herbalife right now.
Yeah, I'm looking at a 3-day chart of Herbalife on my Bloomberg, and you can see the big drop that we had yesterday at the end of the day, right, Oliver? I mean, we had a drop from $62 basically down to 58 at the end. Or it opened,
big numbers.
Opened down that low. So essentially what Carl Icahn is saying maybe is that he's taken advantage of that drop and invested another, what do you say, 2.3 million?
2.3 million shares.
2.3 million shares.
All right, we'll continue to monitor those headlines for you. In the meantime, coming up, Hillary Clinton criticized Donald Trump for his embrace of a disturbing alt-right political ideology. We head to Washington for more. This is Bloomberg.
What'd you miss? The campaign trail has been heating up with words over race this week. Donald Trump accused Hillary Clinton of smearing his supporters as racist, and she accused him of turning his party over to a fringe movement. Joining us now for more is Bloomberg Businessweek's national correspondent Josh Green. Josh, Secretary Clinton's speech yesterday in Reno, Nevada, linking Donald Trump to this quote-unquote alt-right movement. It's been all over headlines. What did you think of her speech? Did it accomplish its goal?
Yeah, I don't think there's any question it accomplished its goal, which was both to tie Donald Trump to this far-right racist element in the Republican Party, but to essentially drag that into the spotlight of the presidential race. And here we are in day two. Clinton was on Morning Joe on MSNBC this morning talking about this live. Trump has been consumed with the issue, issuing tweets and statements. And all of a sudden, the 2016 presidential race is a referendum on who is the bigger racist. I think for the Clintons, that is a fight that they are happy to have with Donald Trump.
Does this last long, do you think, Josh? Because it's great for the Clintons for sure, but it seems like the kind of thing that blows over, at least in this campaign so far. Everything except for Hillary Clinton's emails that just continue to shock and amaze people has died out over a week or two.
You know, I've come up with a law this election cycle. We can call it Green's rule of election scandals, which is that any presidential scandal will go on for as long as Donald Trump decides he wants it to go on for. If Trump keeps fighting back and tweeting and dragging this thing out the way he did with the Khan family scandal, the Gold Star family that he was very critical of after the conventions, if he keeps this up with the alt-right, with racism, then it'll keep going on, and I suspect his numbers will keep falling.
All right, and let's talk about something that you've been writing about. You had an extensive profile on Chief Executive of the campaign, Steve Bannon. What can you tell us about the impact that he has had on Trump's campaign since he was installed? Do you see a recognizable shift?
Well, I do. I mean, Bannon is an interesting figure. He's an ex-Goldman Sachs banker who wound up becoming a filmmaker. He did a documentary on Sarah Palin, which brought him into the Tea Party movement, and eventually became editor-in-chief of Breitbart News, the sort of an alt-right website. So he was brought into the Trump campaign because Trump is someone who talks to Bannon, who trusts him, who listens to him, and he was hoping that Bannon, I think, would make his campaign more punchy, more focused on Hillary Clinton, and more aggressive. The problem for Trump, as we're now discovering, though, is that Bannon brought with him this alt-right association that really opened up the door for the Clinton campaign to turn around and try and connect Trump and the alt-right in a way that apparently is going to be very successful and has turned the campaign into a referendum on race.
Josh, let me ask just quickly, because the alt-right movement, as I understand it, really is linked to a racist, self-professed kind of white supremacy ideologue. To call Breitbart an alt-right publication, are you saying that Breitbart is also a racist publication?
Well, I mean, Bannon has described Breitbart as being a platform for the alt-right, but I would argue the alt-right is broader than just white supremacists. I mean, I think it encompasses everyone from nationalist, populist people who just want an American first foreign policy on one end, all the way to actual white supremacists on the other end. But it tends to go out of its way to be offensive and aggressive. It's very active on social media, and a lot of those supporters have gotten behind Donald Trump. So the profile of this movement has really been raised up in this election cycle.
All right, thanks very much, Josh. Yeah, I'm trying to get my head around this whole alt-right thing because it does seem to have really popped up just in the past couple of days, although I know that the movement dates back years from, my searches in Wikipedia, but... Is this not a fairly new term?
It's a new term for the week. All right, let's get you some breaking news. We want to recap what we told you earlier. Carl Icahn issuing a statement after the close of U.S. trading. He says that today he bought an additional 2.3 million shares of Herbalife and that he continues to believe in the company and that he never gave Jefferies an order to sell any of Herbalife shares. And he is responding to remarks by short seller Bill Ackman that Carl Icahn was trying to sell his stake in the nutrition company. Bill Ackman actually had sent shares of Herbalife down in regular trading, but you can see that following Icahn's remarks, that stock is now up by 3.8% in after hours. This is Bloomberg. Charlotte Fu. What'd you miss? Today's top story was Fed Chair Janet Yellen's comments from Jackson Hole, in which she said the case for an increase in the Fed funds rate has strengthened in recent months, but provided no further guidance. Earlier today, Bloomberg's Mike McKee asked Fed Board of Governors member Jay Powell to elaborate on whether the Fed will tinker with the target inflation rate of 2%.
The economy weakened a little bit in the first part of this year, and it's not clear how much, and it's also the case that the labor market weakened just a little bit. So I think as we've moved toward the middle part of the year, we've got incoming data suggesting that the economy is still basically on the path that it's been on for some years, which is to say growth strong enough to support improvement in the labor market, and improving labor market, which is to say job creation that is taking slack out of the labor market, job creation faster than the growth of the labor force, and inflation moving back to 2%. So I would say that I feel pretty constructive about the economy today.
Do you think that rates need to rise?
My view is and has been that we should be on a program of gradual rate increases. We can afford to be patient, but that when we see progress toward 2% inflation and a tightening labor market and growth strong enough to support all that, we should take the opportunity to do so. Again, in the absence of some big exogenous event like Brexit or such. That's been my view.
Do you think the Fed's been thrown off too many times by exogenous events, the May payrolls, the Brexit? Should the Fed have concentrated more on just responding to the fundamentals of the U.S. economy?
No, I don't. I really think that we are being data-driven, but we're also being patient and a bit cautious because, remember, demand is weak around the world. Other central banks are cutting rates, and we're below our inflation target, and growth was 1.25% in the first half of this year. I think that our caution is appropriate, and I think it has paid dividends and will continue to do so.
So at this point, where would you put a terminal Fed funds rate?
My own view is that the terminal Fed funds rate, which is the rate that would be in place when you're at full employment and 2% inflation, would be 3% or perhaps a little bit lower. And that's, as you know, that's more than a full percentage point lower than the neutral rate would have been before the crisis.
And how long would it take you to get there? And the reason I ask, of course, is because for people on Wall Street, the question is how fast do you go to get there?
That's going to depend on incoming data. It's very, very difficult to say, and there's no preset course. So you've really got to see how the economy performs. Do we continue on this path? I think if we do continue on this path of growth around 2% and reasonably good job creation, then we should, again, be patiently raising interest rates as the economy and in the global economy warrant.
The argument from a number of Fed officials has been that as the unemployment rate goes down, inflation should go up, the Phillips curve. Unemployment's come way down, inflation hasn't go up. Are you a Phillips curve believer?
It's an interesting question, and what's happened is that there's something called the wage Phillips curve. So as the labor market tightens, then wages should go up, and we're just beginning to see that now. We're seeing clear but not really strong dispositive evidence, though, that wages are moving upward. That's good. The transmission between wages and prices has actually weakened over the past 20 years. And also, so the transmission between slack in the labor market and wages has weakened. So the Phillips curve is, as we say, flat, meaning that the connection between slack, wage inflation, and price inflation is much weaker than it has been historically.
Then what gives you confidence that you'll get to the 2% target?
Well, if you look where we are right now, core PCE inflation is about 1.6%. Maybe 30 basis points of that you can attribute to the strong dollar, weak, lower import prices, and weak oil prices, lower oil prices. So as we move through those effects, those should be transient effects. That gets you fairly close to the 2%. It doesn't leave a big gap between 2% and where you would be pro forma for those things. So if we stay on that path with oil prices basically flat, then and the dollar has been pretty, it hasn't been going up, it's actually gone down this year a little bit, then 2% inflation would be very close.
You just heard from Jay Powell, Fed Board of Governors member, with Bloomberg's Mike McKee from sunny and very green Jackson Hole.
All right, we want to get you some more breaking news. It now appears that Herbalife's shareholder, Carl Icahn, has reported a stake of 20.78% after he added to his shares in the company. He bought 2.3 million shares of Herbalife today. This is his announcement after the market closed, and it is leading to a gain in Herbalife shares in after-hours trading of 4%. Coming up, what you need to know to gear up for next week. This is Bloomberg. Coming up, what you need to know for next week. Right now, we'll tell you it's Chinese industrial profits coming out tonight.
9:30. Stay in to watch that. Don't miss this. Japan jobless rate. That's on Monday.
Nobody's going to miss this. On Friday, it's the U.S. jobs report.
That's all
Thanks
for
for
what you
watching.
missed.
We'll see you back here on Monday.
This is Bloomberg.